Hello. In this video, we'll be discussing the 5 components of pension expense. Let's go through the different types of pension plans. The first one is a defined contribution pension plan, which is like a typical 401k is what most of us know it to be. And that's when an employer contributes a certain percentage of the employer's pay into a fund. The employer controls how that money is invested, and upon retirement, that employee is not guaranteed a specific payout. Compared to a defined benefit pension plan is when the employer contributes money into the plan, and upon retirement, the employee gets a fixed retirement benefit when they retire based on a formula that could be based on different things, including the years of service, annual compensation, and sometimes even their age. Let's go through 2 main big items when we're talking about pensions. First is the plan assets. Keep in mind that when we have plan assets, these are the assets of the plan. These are actually kept in a separate legal entity, but there's some accounting that's recorded on our corporation, and that's what we're discussing in these videos in this chapter. And these plan assets are the corporation puts money into the plan assets, they contribute money, and that money is invested, and it might be invested in stocks, in bonds, in real estate, and some of it kept in cash. Okay, then we have what's called the projected benefit obligation, which is the liability that the company has, because this is the obligation that they will need to pay out to the employees, their employees, when they retirement. It's the IOU. So when we record items to the plan assets or the projected benefit obligation, when we do the journal entry, one of the components of the journal entry will be pension expense. There are other components, but we're going to focus on pension expense in this video. There are 5 main components of pension expense. Number 1 is the service cost for the year. We have interest on the liability because it's a long-term liability, and when we're talking about liability, we're talking about the projected benefit obligation. We have the expected return on plan assets. We have a gain or loss depending on different things, and amortization of prior service cost. So let's go through these. Let's start with the amortization of prior service cost. This occurs when a pension plan is amended. Credit is often given for employees service rendered in prior years, and that's called prior service costs. So let's go through an example. Let's just say a company started in 2010, and then 15 years later, they decided to incorporate a defined benefit plan. We'll just call it pension plan. Well, so for all these employees that worked either all or part of these 15 years, they should be incorporated into that plan as if that plan had been in place since the beginning of their employment. And so therefore, what the company is going to incur is what's called a prior service cost. There's some obligation, right? It's a liability, some additional liability, an obligation that the employer will owe as a result of basically giving credit to these employees for the years of service they've already worked. Okay, so let's just say I have a prior service cost. We've calculated this to be $15 million. And there's a whole separate video just for the prior service cost. So let's just go, it's $15 million. So what's going to happen is we have to increase our liability, our projected benefit obligation, by $15 million. And rather than take a hit to pension expense all, in 1 year and have a big, expense item reduce a company's net income, what the FASB has allowed us to do is first record this to other comprehensive income, or it's called OCI. and OCI is part of the stockholders' equity section, which is the balance sheet. So it doesn't directly affect your net income and doesn't have impact on your earnings. OCI at the end of the year will close out into accumulated OCI, which is what goes on your balance sheet. Think of accumulated OCI. Think of the connection between OCI and accumulated OCI. Similar to how net income closes out into retained earnings every year, and then every year your income statement starts anew, but the accumulation of that is in your retained earnings. So back to here, right? And let's just say our plan started 1/1/25. We would record this entry, debit OCI 15 million, credit projected benefit obligation. Then what we're going to do is we're going to look to see how many years do we think that these employees are going to work before retirement, an average. So let's just call it an average of 30 years. We think that most of these average retirement date will be in 2055, so 30 years. So what happens is that you're going to take that $15 million that we booked to OCI and amortize it over the remaining average number of years that we think the employees will be working until retirement, which in this case of 15 million divided by 30 equals $500,000. And we're going to amortize that $500,000 every year. So how we're going to do that is we would debit pension expense for $500,000 every single year. So imagine at the end of the first year, 12/31/25, that the pension is in effect. And we're going to credit the accumulated comprehensive income, which would close into the OCI. My pen's not working properly. But anyhow, imagine like you're going to record this entry right here at the end of each year. So every single year, we would have a $500,000 credit that would be ending up in the accumulated OCI. So this is for 2026. This is and so if you look at the T accounts, this would be for 2026. I can't do it. But and then $500,000 for 2027 and on for 30 years until finally your accumulated OCI will be 0. So again, there's a whole separate video just for this, but this is just a quick overview. Okay, so let's talk about the service cost. And the service cost is adds to the projected benefit obligation, and adds every year, it adds to the liability, and it just represents the increase attributable to employee service performed during the year. So every single year that your employees work for you, your obligation to pay out is going to be higher. So when every year when we record the service cost, we have debit to pension expense for however much that is, and credit to the projected benefit obligation, our liability. And when you see here it says a plus, that means what I'm talking about is I've increased the pension expense, and that's how, by virtue of debiting it. The third component of pension expense is interest cost, and interest cost also accrues on the projected benefit obligation every year. It is when you have a long-term liability, you have to accrue interest on it. And so there's a percentage that's given, and you will take the beginning balance of your projected benefit obligation. Okay, so that's really important. Your beginning balance of the projected benefit obligation multiplied by percentage equals X. And again, you're gonna debit your pension expense for that amount, and then credit your projected benefit obligation for that amount as well. And so again, you see this plus here on interest cost, right here, and that means we've debited our pension expense. The fourth component of pension expense is called expected return on plan assets. Before we talk about the expected return, let's just talk about the different components that make up the plan assets. If you recall, plan assets are the investments that the company puts in stocks, bonds, and other sort of all sorts of investments so that the assets can earn a return on it, right? And because that's what's going to be used to pay out the employees when they retire. So 3 components of plan assets. Number 1 is the actual return on plan assets. So we have these investments in there, and hopefully they grow because the market rate is going up, right? Market's doing well, your real estate value is going up. So your plan assets, the value, the actual return on the plan assets increases. Now, the second component of plan assets is our employer contributions, which when the employer puts cash into the plan assets, right, they just put money in there, the plan assets going to grow. And the third component is the benefits paid. So when the plan assets are used to pay the benefits to the employee when they retire, and so when that happens, the balance of the plan assets decreases. Let's go through an example for plan assets. Global Communication funds its defined benefit pension plan by contributing each year the year's service cost plus a portion of the prior service cost. Cash of $48 million was contributed to the pension fund at the end of 2027. The plan assets at the beginning of 2027 were $300 million. The expected rate of return on the investment of those assets was 9%, but the actual rate was 10%. And retirement benefits of $38 million were paid at the end of 2027 to the retired employees. So let's look to see what happened to our plan asset account rolling it forward from the beginning of the year to the end of the year. We're told in the beginning of the year that it is $300 million. Our actual return on plan assets, we're told here that the actual return was 10%. What this means is this is what the plan asset actually increased by due to the investments and the cash, right? I'm sorry, just the investments. So this is what the plan earned based on the investments in the plan. They actually earned 10%. They're expecting only to earn 9%, but what actually happened was 10. Okay, so it's very important to differentiate between the expected rate of return and the actual rate of return. And then the other one we're told is, so the actual return was 10%, which is 30 million, because you take your 10% times your beginning of the year plan assets, and then you have cash contributions of $48 million, we're told, and then we paid out benefits from the plan of $38 million. So our plan assets at the end of 2027 was $340 million. Let's look at this expected rate of return versus actual rate of return, and we'll go into, there's a whole other video just to talk about that. But the expected rate of return, which would be 9% times $300 million, our beginning balance, equals $27 million. And then we had an additional 1%, right? Because we actually earned a total of 10% of, so really we expected 9% and then we earned another 1%. So in total, our plan assets increased by $30 million, which is, don't know why it's doing that, but which is right there. So the way this is recorded, the plan assets increase, so it's a debit to plan asset. The credit, our expected rate of return, the credit will go to pension expense. Okay, and our pension expense will be going down. This $3 million, right, it will go to other accumulated income, OCI, which we'll get into in a different video. But this is why when we're talking about the 5 components of pension expense, it's just the expected rate of return on the investment of the plan asset is what gets recorded to pension expense. Let's continue with this with some math right here, just so you know. If a problem gives you a different set of facts and says, what is the actual return of the plan assets, which they might ask on the CPA exam? Well, we're given these other facts. We're giving the ending balance as the beginning balance. So we know the difference between the ending and the beginning from the year is $40 million. But when you look at that change between the beginning and the ending, you can't just say, oh, this full $40 million is the return on my plan assets, because there's other things that went into the plan. So you have to remove the contributions by the employer of $48 million and add in the benefits paid. And when you do that, you can back into what the actual return of plan assets is. So this is just kind of a side note from the pension expense, just to how to calculate what the actual return of plan assets are. It's this formula: ending balance less beginning balance less contributions by employer plus benefits paid equals actual return on plan assets. Finally, let's just go into our final component of pension expense, and there's certain gains or losses, and there can be some unexpected swings in pension expense that can result from 2 different things. Number one is the fair value of our plan assets. They can have sudden large changes, and a portion of that may end up impacting pension expense. And then there's changes to the actuarial assumptions that affect the amount of the liability of the projected benefit obligation. If you recall, the projected benefit obligation, it's made up of various assumptions, like how many years we think it'll be before the employees retire, and what is there going to be their lifespan, right? How long will they be in retirement? And so sometimes those estimates change, and those will cause changes in the PBO, which may or may not affect the pension expense. Again, there's going to be a whole other video just devoted to that.